Hi, Dustin here. A famous Chinese proverb states, "If you know the enemy and know yourself, you need not fear the result of 100 battles." In managing our finances, the word enemy refers to money. To get to know money better, allow me to introduce money's two best friends, profit and risk. Money, profit, and risk are inseparable. You cannot win over money without befriending the other two. As a general rule, money flows where it can make the most profit with the least amount of risk. Riskier investments require more profit as a premium for taking on more risk. Where can we see this relationship between money, profit, and risk at work? To help illustrate this, here are 3 examples. First example. Banks lend money to borrowers. Interest rates charged on loans, which constitute the bank's profit, will depend on the level of risk the bank is exposing itself to. On the international stage, credit worthiness of a country depends on its credit rating, which is assessed by reputable rating agencies such as Moody's, Standard & Poor's, and Fitch Ratings. As of November 2022, Fitch Ratings rated the Philippines as BBB, which affirms the Philippines' investment grade status. What is the significance of this? Countries that are deemed investment grade are considered to have healthy economies. Therefore, these countries can avail of lower interest rates and better terms for their foreign loans. To responsibly allocate its available funds for its loan portfolio, banks respect money's relationship with profit and risk. Banks have various kinds of loans, but for the sake of this discussion, let us consider 3 types of loans, namely, home loans, car loans, and credit card loans. Among the 3, home loans are considered the least risky as the bank takes the property as collateral. In the event of a loan default, the bank takes the property into its possession. Though car loans are also secured loans as the car is mortgaged to the bank, the level of risk is higher, mainly because the nature of the collateral is different. Loan exposure in houses is considered safer because real estates generally appreciate value over time. On the other hand, cars are depreciating assets. A brand new car loses 20% of its value the moment it leaves the car dealership. Lastly, credit card loans are unsecured loans because there is no required collateral. As it has the highest level of risk, credit card loans are charged much higher rates than secured or collateralized loans. Second example. It is known that rural banks in the Philippines offer higher interest rates to deposits compared to universal banks. Rural banks, by nature, are less capitalized, hence are considered to be less stable and riskier compared to universal banks. To attract depositors, rural banks are forced to offer higher rates. This is still consistent with the principle of higher risk requiring higher returns as a premium for depositors taking on additional risk. Third example. The interplay of profit and risk can also be seen in the inflow and outflow of capital in world economies. Recently, the US Fed increased its benchmark rate by 75 basis points to 4%, and to counterbalance this, the Philippine Central Bank is expected to match said rate hike to increase its benchmark rate to 5%. Why does the Philippine Central Bank need to do this? To prevent, or at the very least, minimize foreign funds from pulling out of the Philippines. The US is considered as a more developed and safer economy than the Philippines. As can be seen, even though the benchmark rate of the US is still lower, there is a real danger of foreign funds exiting the Philippines in favor of a more developed or safer economy. To rationalize the riskier nature of deploying cash in the Philippines, foreign investors demand a higher rate of return on their investments. Now that we have learned to appreciate the relationship between money, profit, and risk, how can we practically apply this knowledge to better manage our finances? We should be careful where we invest our hard-earned money. Again, investment opportunities offering higher rates of returns are not necessarily better. Risk should always be considered. A little due diligence will go a long way. Thank you for listening. If you found value in the information I shared with you, I would appreciate it if you could press the like button and share this video with your friends and family. Also, if you want to listen to similar videos in the future, do subscribe to this channel. Dustin out.